The S&P market has shown a little more weakness the last few days, but our basic forecast has not changed. Today is November 18th. Markets are closing. And the cycles we've been looking at have been telling us that there is a correction that probably started on the 28th of October, and it's probably not going to finish possibly until late January, even early February. It does not mean we're going to have a huge 20% break or anything huge like that, but most of the cycles do indicate choppiness and swings in both directions. What's been happening is the liquidity's been drying up a little bit lately, and because of that, the volatility has become more extreme. You see the S&P gapping more frequently. You see the moves being very fast in one direction, then very fast in the other direction, like nobody knows what to do. Tomorrow, the 19th, I think the NVIDIA report comes out, earnings come out, some other things late this week. The probabilities are, however, we were looking for a low on the 13th, and it bounced, and it did happen. We were looking for a low on the between the 17th and the 19th, and that's in progress right now. We didn't expect it to be lower than the one on the 13th, and it did break below our immediate up channel. So that could mean we go a little bit lower still. However, it's probably starting tomorrow or the 20th, the market should start to rally and work its way higher until Thanksgiving, believe it or not, our original forecast, and then potentially even higher until the 4th, or between the 2nd and the 4th of December. Note, this whole business is a correction. So we're in some sort of long-term A wave, going into a B wave, going into a C wave in December, and it's possible that the decline in December will be a little bit more nasty. Even though this thing is going down, it's not going down fast. It's very, very gradual, and it's retesting support, and then it bounces. It doesn't know what to do, and it's holding support at the moment. Although one trend line did break, but the major supports did not break. We have started our most recent Market Forecast Mastery course. It's been great so far. If you are interested, we'll allow people to come in after the first week. They can review the video of the first class, and then they jump in with the rest of the group. If you are still interested, you can still do so. And so there are several cycles that are working still. The 54 trading day cycle expected this decline until today. And the 87 times 2, 174 trading day cycle is exactly on track as well. And it expected a decline till today. Okay. We didn't think it would be deeper than last week, but nevertheless, the low area is probably here or near. And then they both go up into early December. And if you can see, there's also a 604-hour cycle, which is really sweet. It's been repeating beautifully. Turns out it's 1 1/3 times the cycle of the moon. And it's been calling highs and lows, the whole rally up very well. And it calls for a high on December 4th as well. So we should start to see some upside action despite the fear. The fear and greed index is at ridiculously fearful levels. I think it was down at 11% today or something, which is extremely bad. And as you know, the fear and greed index is a counter indicator, okay? And usually when the fear gets that extreme, the market doesn't want to go down. Usually it turns back up, even short term. It's not necessarily a long-term indicator. But right now it looks as if anything, the market needs to bounce back up. Yeah, oftentimes what happens when the public starts getting very fearful, the professionals see this as an opportunity to get in and buy at cheaper prices. They prefer it to go down and get at better prices than they had before if they missed a move in particularly this time of the year, toward the end of the year. They want to catch up and they want to do some of the window dressing to make their portfolios look more satisfying. In any event, it is true the market has gotten down. It is true that it went down almost 6% from the tick high to the tick low so far, which is more than it has lately. And that means something. It doesn't mean, however, the market's going to crash. It does mean we're in a correction. The correction is not done. It will probably go up and down again, possibly twice. Up and down, and then up in December, at the end of December, down again in January. And then finally, after that whole rigmarole, it'll take off in what we consider to be the fifth wave of this rally. Still expecting 7,600 by next spring, probably by April. And there are several cycles that say that, and they say it strongly. And so one of them is this 1,566 trading days, which ultimately is 6.2 years. and that one goes up into April. There's another one of 369 trading days. That one goes up into April. There's 3 times the 6.2-year cycle is 18.6-year cycle, which we spoke of several weeks ago as bottoming after the sharp break in February of 2007. That runs up also into April. So this is a correction. It's probably going to go sideways for another month or even 2. And you don't want to get too nervous about it. If you're a talented trader, you might think about buying these dips and selling the rallies. If you don't want to do anything, it's not a terrible idea to hedge, at least until February. And if you're a day trader, you just have to watch it day by day. We can't necessarily call it that accurately on a day-by-day basis. Although right at the moment, it looks like this 19th or 20th date may be a low, even though there's a combust retrograde Mercury, which usually is a high point. It's sometimes, and the last time it happened, it was a low point, and then the market started to go sideways into the next high. Okay, so I think ultimately we are in a reasonable, sideways, slowly slipping, not the beginning of a bear market, something that you can trade, or you can day trade, or you can do nothing with, except potentially put on some hedges. And we still favor the next couple of weeks, the market will probably go higher. And that's the story.